Hi, so in today's video, I'm going to discuss about the 10 questions that you should ask yourself before investing in any financial product to ensure that you are not rushing into it and thinking through all the different possibilities and then only investing your hard earned money into it so that you don't fall into any trap, right? So I think lately we are seeing that there is a bull market going on in India, and the stock prices are rising like anything, and people are making great returns. But we should keep in mind that the biggest financial mistakes are actually made during the bull market, and they're uncovered during the bear markets. So not only India, it can apply to any economy in the world. I think when the stock prices are rising and everything is going good, that is when people actually make mistakes, blunders, and then they actually pay the price for it when the markets go down. So I think if you ask yourself these 10 questions, that will help to ensure that you are thinking through all the possibilities, asking the right questions, and then only taking the investment decisions. So the first question you should ask yourself is, am I being led by FOMO, or the fear of missing out? Right. So just ask yourself, like, am I buying this product, or am I investing in this particular product just because everyone else is doing it? Because if that is the case, then most probably it is not the right investment choice. Because returns are never created by buying what everyone else is buying at a similar or a higher price. Your More than anything else, your goals, not FOMO, should define your investment choices. Second question is, am I earning a lot more than the risk free rate? If so, that should actually ring some alarm. If a financial product, especially a debt offering, promises much higher returns than the existing risk free rate, that too in a guaranteed and consistent manner, it is an immediate red flag. Debt returns greater than the risk free rate come with risk, right? So remember, in debt investing, safety of capital matters the most. Number three, ask yourself, what gives me a right to make money? Do I understand why this product will make money, and am I convinced with that argument? Has it made money in similar times in the past? Make sure to check the past returns and ensure that you have realistic return expectations from the product as well. Number four, why will I lose money? When will I lose money, and when will I lose a lot of money? In what market conditions? Find out, especially if the product has lost money in the past, especially extreme money. Compare if those situations remind you of something today. Number five, what value will this add to my portfolio? You don't buy a product just because it got launched, right? It should meet a need in your portfolio, and it should add an exposure that you already don't have. Are you buying a third tech fund, thus tripling down on tech exposure, or are you buying something genuinely new? Don't load up on mutual funds like clothes in a closet. Number six, what am I paying for this? Do you know the fee structure for that product? Like, what are the fees that are you are being charged for investing in that product? They know that the person who is offering the product is charging you in return for their services. Is this product too cheap? And if so, what am I missing? It's important to understand costs and costs in completion and detail. Number seven, why should I lock my money? Now, we all know that there are certain products in the market that lock up your money for a certain period of time, be it 3 years or 15 years, for example, NPS, PPF, ELSS. So you should understand that why those locking things are happening. Like, if you are locking your money, you should obviously get something in return. And you should also ask, like, how can I exit if something goes wrong? Remember, if you are giving up on liquidity, you should get significant incremental returns for doing so. Number 8, are there simpler products with similar risk reward? Can I get the same return risk exposure in a simpler, cheaper, or more liquid product? Simplicity is always the preferred option. Number 9, is the product well regulated? This is a very important question. Do I trust the firm or the person I am handing over my money to? Have they done the job well in the past? Have I done the reference checks? Why do I trust them? What is my regulatory recourse if things go wrong? You must have all the answers. Never buy unregulated products. Else, in case things go downhill, you may find it very challenging to recover your money. So definitely the product has to be well regulated. Lastly, number 10th question is, what do I need to monitor after investing? Investments need to be monitored. Understand the disclosures and information you need to monitor after investing. Ask if this will be available. If there is no transparency, it is a red flag. Money is hard earned, my friends, and should always be invested sensibly, safely, and wisely. Keep caution at an all time high, and remember, no question is a bad question.